If you're self-employed and you're a first-time home buyer, you're probably looking for some tips on how to buy a house when maybe you've gone to a bank, talked to a loan officer, and they've told you after looking at your tax returns that you don't claim enough income to qualify. Well, I've been doing quite a few loans for first-time home buyers lately, who are self-employed, and I just wanted to talk over a few things that you need to think about. Some of the most common misconceptions are that you can get, traditional first-time down payment assistance programs or first-time home buyer programs using alternative income documentation. And really, you can't. So the only way to be able to put 3% down or 3.5% down or even 5% down is to use 2 years of tax returns and to get either a conventional loan, an FHA loan, VA loan, etc. When you find that you don't claim enough income on your tax returns to qualify for a traditional loan, then what we have to look at is alternative income documentation loan. And then really they're called non-QM loans. The number one thing to remember on these type of loans is that the minimum down payment is 10% of the purchase price. And then also you're going to have 3 to 6 months of mortgage payments in what they call reserve after closing. That means that you have to be able to show that you can make up to 3 to 6 months of payments by having money either in a bank account, retirement account, something like that. The second thing to remember is you can get a gift for down payment, but at least 5% of the down payment has to come from your own funds. Now that can come, from your business bank account, but it has to be your money. The other 5% can be a gift from a family member or something like that. And also critical to remember is that those reserves that you're going to have in a bank account cannot be gifted. So in essence, before you even start looking at these programs, make sure you have at least 10% of the purchase price of whatever house you're interested in some sort of account. Now, there are programs for these types of loans where you could be in business for just 1 year, but generally you're going to need 2 years. That just means that you have to have, really incorporated or started a business at least 2 years ago. And the way that we typically do these types of loans is through bank statements. So what you're going to need to do is have the most recent 12 months of bank statements. So I'm recording this in December of 2025. That means if you were doing a loan this month, you would need to have last December of 2024 all the way through November of 25. And then we would take the average of those deposits, take at least 50% of those deposits, and that will be your annual income. Now, what I typically find is that there's plenty of money in those deposits to have enough income to qualify for more home than you want to buy. But really the limiting factor sometimes I find is having that 10% down. So make sure you have that. Also, when you're putting just 10% down, you're at the very, bleeding edge of qualifying for these loans. That means that the rate's going to be higher. So I would prepare for an interest rate of 8%, possibly a little bit lower. And usually these are going to come with points. In other words, you're going to have to pay maybe up to 2% of the loan amount in what they call origination points. So there's going to be a lot of closing costs. Now, another thing to remember is that you can have the seller pay for the majority of those closing costs. So you might want to, one tip is to negotiate or have your real estate agent negotiate maybe a slightly higher sales price so the seller can end up giving you a lot of closing costs. You might have $15,000 in closing costs, for example, possibly more. So in general, it's not going to be cheap to be a first-time home buyer and put just 10% down, but it is going to get you in the house. And then as soon as you have some years of tax returns where you're showing enough income to qualify, we would just refinance you into a lower interest rate loan. Or, really, frankly, what most of my clients do is as the home appreciates and their business income goes up, they might refinance, either just put more money down, or at that point, they have more equity in the home. And then these bank statement and alternative income documentation loans, well, the interest rates, are going to come down. So the more money you put down, the lower the interest rate. The higher the credit score, of course, the lower the interest rate. So if, again, you're a first-time home buyer, wanting to put a minimum down payment down on a home and use bank statements instead of tax returns, then reach out to me. I hope you found this video helpful. Feel free to put questions in the comments. Go to my website, mortgagesbyscott.com, and I appreciate you watching. If you found it helpful, please click the like and subscribe button and share it with a friend. All right.